Hi, everyone. Good afternoon. And hi, Jay. It's great to have you with us. Once again, a lot to talk about. It's been a few interesting days in the markets since this the CPI print, and which, as you said in the musings, it was bad, but was not like 4% bad. So, but I guess, I guess people went into the news. Maybe equity investors were too optimistic. But let me turn to you, and I'd like to hear what you mean about the day trip. And how is your trip going on? And I guess you had to stay a couple of days away from the markets. But
Yes,
let us know. Yeah.
thanks, Roberto, and hello, everybody, and greetings from Durham, North Carolina. So yes, I had the day trip out to the beach last week, out to Fire Island, which is a fantastic spot off the coast of Long Island, and really just had a wonderful day across the board. You know how sometimes you decide to take these trips and you're not really sure whether you should, blah blah blah, and then you do, and it ends up being a great time, right? Almost always, it's a good decision to go on make those kind of decisions, make those moves, go on those little day trips. So that was last week. It was a beach trip, my first and only beach trip of the summer. So it was like mid-September. I want to go to the beach and I need to go quickly because the summer's over. And so that was last week. This week, I'm down in North Carolina at Duke University, where I went, and one of my sons currently is a student here. So I went to the football game, American football, not what the Brazilians call
Yeah.
football, of course, the beautiful game, but American football, which I think is beautiful. And I'm happy to say that Duke is 3-0. So it's always great. We saw a nice victory on Saturday night. And now I'm here for a couple days of meetings, and so still paying attention to the markets, but just doing so from North Carolina for this week as opposed to New York. But yeah, I mean, I think your point about the CPI, to me, it was a classic buy the rumor, sell the news, right? So remember that the S&P was up 4 days in a row. I
Yeah.
mean, it had first been down 6 days in a row, then up 4 days in a row. Then we got the print, which again was disappointing, right? I mean, it wasn't horrible, but it was definitely disappointing. And those of us who were waiting for that kind of clear, definitive rollover are still not satisfied with what we've seen. And so stocks sold off and, very aggressively with very light volume. And again, as we've talked about with our piece a couple weeks ago, lines in the sand, the market is being driven by technical levels. And so it went right to the 38, after a day or two, right to the 3850 level, which is an important technical level, according to
Mhm.
some of the technicians. And that's the environment that we're in, right? We're in a frustrating bear market type environment, grinding markets, thin volume, very easy to get whipsawed, very easy to get chopped up. And one of our theses at TPW Advisory is we're trying not to play that trading game, right? Because I do think it's very difficult to do it successfully, and you run the real risk of getting chopped up in these markets. So we continue to try and hold the longer term view and position ourselves accordingly in our two model portfolios. And so for us, the data point was disappointing. And really, the important point from our perspective is what does it mean for the end of the front loading, right? Because the Fed has been very aggressive in front loading the rate hikes, 75 basis point hikes. We've had several of them versus before that, only one other time had the Fed raised rates 75 basis points. And then now we're talking about 100. I think that's highly unlikely. I think on Wednesday, we're going to get 75 basis points. And the question is going to be, is that the last of the 75 basis point hikes? I think it will be, but it may not be as definitive as one would have liked, right? Because I think right now the market is pricing in 250 basis point hikes in November and December, and that will bring us to about 4% to 4.25
Four and a quarter, yeah.
for the Fed funds rate, and that's going to be I think, a pretty healthy number. We'll get into why I think that in a little bit. But remember, for us, the big key is the rolling over of the dollar, right? That's what we're really looking for. And our thesis is that when the Fed clearly ends the front loading of rate hikes, that will also mark the peak of the dollar. And so that's really the key that we're watching for, because I think the peak in the dollar is going to set off significant asset allocation opportunities across assets, not only stocks and bonds, but also commodities. And so that's really the focus for us at TBW Advisory.
No, I totally agree, and I had a call with an investor today about this, and mentioning exactly that. So, I mean, I think 75 basis points is a done deal on Wednesday, and I guess, you know, if I understood what you said, the market is going to be trying to, you know, read between the lines and looking for every cue as possible from Powell on whether or not this is going to be the last off-sized hike. I mean, of course, you know, he may not want to give, you know, people a free option, and of course, you know, keep some options for himself. But do you agree that that's the case? That, you know, that's exactly what people are going to be looking for. That, okay, I don't know if he's going to say, okay, or imply that we're going to do 50 and 50. And I agree that that's the key, you know, to markets now is rolling over of the dollar. And as I like to say, I mean, there's only two financial assets in the world. I mean, if you want to be simplistic, it's the U.S. dollar and everything else. So I mean, and then within everything else, you have, of course, you know, you have you know, 1,000 shades of gray.
Right.
But do you agree that that's you know, exactly what people are going to be looking for? You know, trying to, you know, look at Powell's words and trying to say, okay, and trying to get, you know, something along these lines.
Well, yeah, I mean, clearly investors are going to be focused on what he says. And also remember, the Fed will release its updated economic forecast.
Yeah.
That's also kind of important to see what they think the impact of the rate hikes that they've done to date, what it's going to mean for the economy going forward. And that's obviously an important point, because we continue to focus on the front loading, and we've taken rates from negative levels a year ago to strongly,
Yeah.
you know, to rate levels we haven't seen in a decade, within the space of 6 or 9 months. And supposedly monetary policy works with a lag. So,
Yeah.
you know, you're going to see the effect of it over time. There has to be a point at which we slow the pace down or pause and assess, you know, the impact of our rate hikes to date. And I think we're getting, you know, closer and closer to that point. I mean, I would make kind of 2 points. The stuff that again I wrote about in the musings and we're paying a lot of attention to. One is the hockey stick hike in rates, right? Which I referenced, you know, the 300 basis points of hike in the mortgage rate over the last 6 months is the most in 40 years. The last time we had such an aggressive hike in such a short period of time was in the early 1980s. And every rate, you know, every interest rate you look at looks the same. It's a hockey stick. And so that has clearly manifested in the strong dollar. One of the things that's interesting in terms of this idea of peak dollar is that the 2-year, for example, has risen dramatically in just the last month, almost 100 basis points, somewhere around 85 to 90 basis points in the last month. And yet the dollar is no stronger today than it was a month ago. So one could argue that that relationship between rising rates and a strengthening dollar, which has been pretty consistent, you know, maybe topping out, in part because Europe is raising rates as well. So that interest rate differential at the 2-year level is narrower now than it was a couple months ago. I think it peaked, excuse me, in August at about 280 basis points. and now it's right around 230 basis points. So this the spread between the 2-year bond and the 2-year dollar rate. All right, so that spread is narrowing, and one of the things that we think is going to continue to support the rollover of the dollar is we expect the ECB to probably be more aggressive than the Fed over the next 6 to 12 months. So we think the Fed is getting closer to the end, or pausing or stabilizing its rate hike environment, where it's pretty clear the ECB has got several more hikes to go, and so the rate hike that's already been priced into the 2-year level in the U.S. is probably already reached its widest point versus the European rate, and therefore that's one of the planks that may weaken the dollar. Right, that spread is now narrower than it has, and it's probably going to continue to narrow, which means that for everybody who wants to, constantly say that the euro's got to get cheaper and cheaper, there are some basic things like interest rate differentials, which would suggest that's maybe not the case.
Yeah, and you also think that the Asian central banks, the People's Bank of China and also the Bank of Japan, do you think, I mean, I don't think the POBC is doing anything to intervene. I mean, I think the Bank of Japan, yes. Do you think they could do anything, to help the rolling over of the dollar, or is it going to be more or less, the euro or ECB, be more aggressive, and also the fact that the peak hawkishness of the Fed?
Well, it's kind of interesting you raise that, Roberto, because the interest rate differential in China is going the other way, right?
Yeah.
That spread has kind of blown out in favor of the dollar, and that's one of the reasons why the dollar has been stronger against the yuan, breaking the 7 level, right? And I don't think that's a big deal, and I'm actually kind of pleased to see that the market's not making a huge fuss out of the 7 level in the U.S. in the dollar yuan ratio. So I think what's going to make the difference there is that China accelerates its growth profile, right? We're counting on that desynchronized nature of the global economy, where the U.S. and Europe may be slowing, though arguably Q3 growth in the U.S. will be the strongest of the year to date. So it's kind of hard to say that it's slowing, but the pace of growth in China should be accelerating, and also in Japan and in broader Asia as well. So that's the desynchronized nature of the economy, which we think supports a global economy that's unlikely to go into recession. And then you have the policy desynchronization, where the Fed and ECB clearly raising rates, and the PBOC clearly cutting rates, and the Bank of Japan basically sitting, not doing very much. And they don't feel the need to, because even though the currency, you could argue that the yen is kind of blown out against the dollar at 144 or 145, there's no big inflationary pressure in Japan, that Japan wants some inflation. And so there's not an impetus for them to move as one would think. So that's why the dollar probably doesn't collapse. The point is that it rolls over, and people start to understand that the direction it's now a two-way street, and maybe direction going down for a period of time after one of the biggest runs for the dollar in a long time, and that has led, as we've talked about before, to massive outperformance of U.S. Financial assets and massive holdings by foreigners of U.S. financial assets. Right, I think that was 2 musings ago. We put the number down at 17 trillion net in foreign holdings of U.S. financial assets. So if people decide that the dollar is going to start to weaken and they want to go into some of their own currencies, there's an awful lot of money that can start to move in that direction.
Yeah, and I agree. That's exactly what the market is looking for. But the next point that we're talking about, and you just briefly touched on it, was the data flow out of China. So does it look like it's finally the time? And they I was expecting the release, the not the release, but the relaxation of the lockdowns in Chengdu today would have a bigger impact on the market. I don't know. Maybe people are waiting for something after the CCP's 5 year meeting
Hmm.
in October. So
Hmm.
how do you see the data flow out of China and impacting the desynchronized growth, as you said?
Well, I mean, first of all, I think the Chengdu lockdown ending after 2 weeks is pretty important, because that's the key. Hard to kind of be have animal spirits when you're locked down, right? Hard to have
Yeah.
demand when you're locked down. So the fact that the Chengdu lockdown was 2 weeks versus the Shanghai lockdown of 2 months, that gives me actually a fair bit of confidence that things are moving in the right direction on COVID, which is critical to stimulating the demand side. The issue for China is demand. And that's where, you have to remember, we have to remember as investors that they're just coming out of their lockdowns.
Yeah.
The lockdowns were a couple months ago. I'm a New Yorker. Our lockdown was 18 months ago, 2 years ago. So it's now fully in the past. For folks in Beijing and Shanghai, it's a very recent memory.
Yeah.
So their appetite to consume is not as robust as one would like it. And I think a big part of that is the property sector. And we've talked about that at some length now the last couple months. Our view. Our view is that the government has drawn a line under it. They're not going to allow it to get worse. They're going to force the developers, and they're going to fund the developers through a bailout package to finish the bought for but not yet built
Yeah.
apartments. And once those apartments get built, they've already been sold. So the people move in, they have to buy things to furnish their new home, and that will help consumption, and that will help the economy. So I continue to look very carefully at our Asian high yield bond fund, which has a pretty decent chunk of China real estate development in it. It's about 30% of that Asian high yield bond fund. And that bond fund continues to do fine. So, notwithstanding all the negativity around the developer property space in China, this Asian high yield bond fund with a 30% allocation to China real estate developers is actually continues to be a top 5 performer for us up through the recent period. I just had the data run through Friday's close. The top 5 performer in our global multi-asset model. So that's an
Oh, it's an ETF, right?
yeah, that's an important indicator of the fact that from the market's point of view, all the property stuff is very well known, and there's nobody investing in China who isn't very aware of the property issue. And once you start to see it improving,
What's the
that
ticker for
brings
that
people
ETF?
back in. I'm sorry,
The ticker for that ETF?
KHYB.
Okay, HYB.
Yeah. So yes, I mean, I think China gradually, their economy gradually starts to pick up. Maybe there's more policy action post the People's Party Congress in now less than a month. But in essence, I think the important point is that China is going to probably grow at 3 to 4% in the second half of the year, and that's going to be supported for the global economy. China is growing reasonably well, and Southeast Asia. The other point is that many of these emerging countries are much closer to the end of their rate hike cycles than some of the developed countries. And typically the emerging countries get, kind of all whacked around when these things happen in the developed countries. And this time, that's not really been the case, right? I mean, EEM is basically flat with the rest of the world. I mean, maybe underperforming by 100 basis points or so, but not anything dramatic. And these countries are close to having their rate hikes done. And that would suggest, again, opportunity for growth in some of these countries, particularly if the dollar rolls over. That's good for commodities. That's good for non-U.S. assets, and that's obviously what emerging markets are. So, as you know, again, we've been gradually adding and building up over the last, I'd say, 2 to 3 months, emerging market allocations, both debt and equity and currency. And so far, that's been working out okay. It hasn't been fantastic. They haven't gone on off to the races, but they're not performing any worse than
Yeah.
the developed market. So in net, it's basically a wash. And we think as the things happen that we've just been talking about, EM should be a beneficiary of some of these trends.
No, I agree, and I think we discussed, not in, maybe 2 sessions ago, that a lot of the bulge bracket firms are warming up to the emerging market idea. So I mean, as soon as they sense that the dollar has peaked, and God knows, maybe after Wednesday, they'll feel stronger about that. You're gonna have all of these shops saying that it's emerging markets are the new thing again. Looking at valuations, back to the lows of year 2000. So no, yeah, I agree.
Yes, yeah, definitely. That's the we were talking about how the dollar rollover will catalyze Wall Street to recommend EM, right? I think
Yeah,
that's absolutely the case, which is why we've been trying to build up our positions beforehand, thinking that much of the risk and of the downside is in the price, looking at things like KHYB to clarify that point, and then deciding, okay, let's add and build our position so that when the time does come and Wall Street does recommend these things and that cash moves into those markets, we're not competing to buy. We're allowing that flow to lift us higher because we're already there.
yeah.
That's
No,
that's
and,
that's
and
how it's supposed to work, Roberto. I'm not sure it doesn't always work that way, but that is the way it's supposed to work, my friend. Let's hope it
yeah,
does
exactly. And give, we're talking about China. One thing we chatted, before we went live is, and I think that's a good thing. How Xi Jinping treated Vladimir Putin in during the conference last week. So it was pretty much a kind of a cold reception.
though.
And the Chinese, they of course, they believe a lot in these symbolisms, and and that's all part of the diplomatic game. So what's and then I saw you mention that in the Musings. So what's your take on that? What does that mean for the growth outlook, for geopolitics, and asset allocation, and of course, the outlook for the war?
Yeah, I think it was very clear that President Xi did not really give anything to President Putin. So it was a cold shoulder. It was a diss. It was being treated like a junior partner,
Yeah,
very much so. And I think there's no real upside for President Xi to do more than that for President Putin at this point, because the war is going against Russia. That's pretty clear. It's hard to argue that at this point. He's played his trump card with the shutdown of the Nord Stream 1
right. Yeah,
pipeline. The result of that has been a halving of European benchmark natural gas prices, which it was not part of the playbook for Russia, I'm sure. I'm sure they didn't think that they would shut Nord Stream completely 2 months before the start of winter and gas prices in Europe would halve. That was not the idea. And subsequent, obviously, those gas prices continue to decline. I mean, the peak was around 350, and right now they're trading somewhere around 170 or 180
yeah,
currently. And by the way, they've reduced usage considerably. I just saw some data today that Germany for August used 22% less gas than it did over the prior 4-year average for August. So like for like period, 22% down in terms of gas usage. So I continue to think that Europe will get through the winter okay. There's not going to be this massive recession. There's not going to be, rationing and power outages and all these things that people have been talking about for months. And so to me, it's really interesting because the trend in energy prices is definitely moving in a positive risk, appetite basis. But yet there's no sign of any increased risk appetite. If anything, it's like a wash, like no one's paying any more attention. So I think it's starting to feel to me like there's a lot of kind of stale bearishness. People are bearish because, you have to be bearish because, Russia
Everybody is, yeah.
and war and energy prices, as opposed to, it was really bad, but things are getting materially better. And Goldman and others have come out and saying that the nat gas price is probably going to go from 180 to 100 by the end of the winter, and then have again over the course of next year. And so clearly things are moving in the right direction. But the euro is still at 1. Stocks in Europe aren't going up. All the things that we've talked about, the bull case for European equities, valuation, flows. It's now, I think, 30 straight weeks of outflows from European equity funds, 30 straight weeks, right? Trading at 11 and a half times forward earnings, one of the biggest discounts to the U.S. U.S. is trading at 17 times forward earnings. Earnings in Europe are relatively good. Certainly Q2 was good. Let's see what Q3 comes in the next couple of weeks. But to me, there's just, and it's very similar, I think, to maybe switching gears a bit to the U.S., where I talked in the Musings last Friday about how if we continue the same month-over-month inflation prints, right? 0, minus 0.1, plus 0.1, by March, we're going to be under 4% on the headline CPI by March. That's only 6 months away.
Yeah.
And so again, it's the same thing. Very, everyone's bearish and worried about inflation, as opposed to, those were the last 3 month-over-month prints, minus 0.1, flat, and plus 0.1. And so that's the new kind of level, and it's kind of unlikely that we're going to spike up, given that all the transitory stuff is falling, right? Price of energy, price of food, price of used cars, house prices, etc. So the arguably that those numbers are going to be better, i.e. lower, and we may get to under 4% inflation sooner. But it just strikes me, and as I wrote about it in the Musings, the time to be really bearish because of inflation and really bearish on risk and bullish on cash, I think is coming closer and closer to the close of that. And yet there's no real sign of any kind of renewed risk appetite or animal spirits or anything like that really anywhere. And the best example of that is, of course, the Bank of America Fund Manager Survey, which just continues to demonstrate, absolute, what would seem to be absolute peak levels of risk aversion, right? Let me just give you 3 that I wrote about in the Musings, right? Record low risk appetite. So in terms of how much risk fund managers are taking, they are saying it's at a record low, below that in 08. And, again, as we've said several times, we're not in any situation like 08. There's nothing other than maybe the overlay charts that people
we talked about.
People talking about. People like to show the charts, but fundamentally, 08 was a deflationary credit bust and a banking bust. We don't have any of those situations. There's no deflation. There's no, banks are flush with money, absolutely flush with money. Housing, consumers flush with money, record low unemployment, and companies flush with money. So, but nonetheless, the record low risk appetite, lower than in 08, record high cash allocation, record low equity allocation, and a record most crowded trade being the
The
dollar,
dollar, yeah.
the most crowded that they've seen of any asset since tech back in the fall of 2020. So that tells me that we're at extremes of risk aversion at a time when arguably, the three things that we focused on for the second half, pace of U.S. inflation, path of European energy, and path of China exiting COVID and lockdowns, all three are moving in the right direction. And yet there's no real appreciation of that in terms of risk asset pricing. So maybe so to me, we're kind of, it seems, getting close to a point where that should happen. Now, the one thing that one could argue is reflecting a better tone is the fact that notwithstanding financial conditions in the U.S. getting tighter and real rates in the U.S. now over 1%, that the S&P is still 6% or so above the lows of mid-June. So arguably, rates are higher. Real rate, nominal rates significantly higher. We talked about the 2-year up almost 100 basis points in a month. Nominal rates higher. Real rates over 1%, which typically tends to be kind of the ceiling, at least or over the last, not sure exactly the period of time, but for quite some time, real rates of 1% have kind of been the ceiling. And financial conditions are tighter. And yet stocks are higher. So that, one could argue, is a good sign. But it just strikes me how the path of European energy prices in this idea, if we just stay at the same month over month pace of inflation, the numbers are going to be much, much better in a very short period of time, tells me that the clock, I think, is running out on the super bearish, record risk aversion that the Bank of America survey is highlighting.
Yeah, no, I agree, and I just want to go back, because I wanted to make sure I mentioned this. It's a point related to Europe, and that's the fact that maybe people underestimate, how much Europeans can save energy, can save gas. And one thing I did not know, and I read the other day, is that up to the mid 90s, public buildings, used to be heated at 19 degrees, 19 Celsius, and now it's 22. And part of the measures where they are guiding the country. Yeah, it's going back to 19. So, and people are panicking and say, okay, it's as if people are going to freeze to death. I mean, of course, that's not going to be the case. And
right.
So there's a lot of fear mongering and ignorance about this, and people are just bearish because they feel they have to be bearish, and it's every day. It's either someone, it's either a big hedge fund or a bank, saying that it's been Morgan Stanley. There's been a couple of the others saying that the market is going to bottom at X. I mean, if everybody thinks that, I mean, of course it's going to bottom in a way before, right?
Well, exactly, and I think that, as I mentioned, we've had a dramatically higher rate profile, real and nominal, and a significant tightening of financial conditions, and yet stocks don't want to go down, or don't seem to want to go down back to the levels they were several months ago. And now again, we're coming up on, after the Fed meeting here a day or two on Wednesday. The next thing is going to be earnings. And, Q3 earnings, according to FactSet, are expected to grow about 4% year over year. Now, that's not like light the house on fire exciting, but nor is it the 15 or 20% earnings decline that folks who think we need to go down another leg are trying to make that argument. That next leg down comes from earnings disappointing due to recession, et cetera, right? Yeah. And, our feeling has been and continues to be, and we wrote that piece back in July about earnings bridge, right? That there was going to be an earnings bridge over the question of when does inflation peak, an earnings bridge that would cover us because of this high nominal growth world, which would allow for very solid sales, companies having pricing power, and companies having good margins because they've spent the last 2 years with COVID really focused on the expense side because they really couldn't do very much on the demand side, right? Because demand was frozen because of COVID. So everyone focused on the cost side. And so now you have a situation where, again, I think the high nominal growth world we're in is going to support earnings, and we're going to have, again, the fact set consensus is for 4% earnings growth. And that's not the kind of environment where you get another leg down. I think at some point the onus has to kind of shift to the bears to really make their case as to when is this actually going to happen. And at a certain point, that there's, if the Fed has already, raised rates to 4%, housing is already down sharply. And yes, it takes time for the, shelter calculation to get into the CPI, but it's pretty clear where housing is headed, and it's headed down. The Fed is, clearly not going to miss that. And the unemployment side, remains to be seen, but the last jobs number was actually pretty decent in terms of slowing demand for wage earnings and things of that nature, which the Fed wants to see. So, when I look, I think it's Bank of America, but they have a 3-month global earnings revision indicator. And that indicator is suggesting global earnings growth over the next 12 months of 7%.
Mm-hmm.
So, yes, I guess analysts could all be wrong. And,
and it's lagging, of course. Yeah,
they'll miss this abyss that supposedly we're going to fall into. But I also think one could start to argue the other way that earnings are holding up. They're holding up because we're in a high nominal growth world. We're going to stay in that world. And 2023 may not be as horrible as people are making it out to be. You have Asia recovering. You have Europe having gotten through this energy crisis. And you'll have the U.S. With a Fed that's probably going to be pretty close to done, particularly if we have inflation trending under 4 by March. It's hard to see a recession between now and March.
Yeah.
And if we're under 4% inflation by March, I don't know, maybe we don't get the recession and we don't get the earnings leg down, and that bottom in June will end up being the bottom.
Yeah, and a couple of things. One, I mean, if maybe something that the bears are counting on is the FedEx stuff, like the FedEx could be the tip of the iceberg, and we could see a ton of companies announcing the same thing. So maybe that's something that they're counting on.
Well, I mean, perhaps, but the pre-announcement, pre-earnings announcement for bad news, that period's already kind of passed.
Yeah,
we're weeks away, from earnings, right? Less than 3 weeks away. So I would think that FactSet number is a pretty reasonable number. That 4% earnings growth was from a FactSet report at the end of last week. So that's a current number. And FedEx, has a long history of disappointing and coming out and doing exactly what they did, even though it's under new guidance, a new CEO. A number of firms went back and looked at the last number of big kind of FedEx announcements down, and it's pretty much the norm for the company. I think that, again, we have to focus on the market as a whole. And the market as a whole is the FactSet consensus suggesting 4% earnings growth. So I think you got to, be careful. There's always different companies doing different levels of success. It's also worth pointing out that neither of FedEx's main competitors came out with the same warnings, right? So that would suggest it's a FedEx specific issue rather than a broad economic wide issue. Roberto, I think we lost you.
Sorry. I'm back. My connection was very unstable.
Yep,
So
no
sorry.
problem.
Sorry, to go back to the FedEx, that's where I lost you. So they have a history of disappointment, right?
Yep. And the other point I was just making was that none of their competitors have made the same guidance, right?
That's a great
So
point. Yeah.
it suggests it's more of company specific. And again, we go back, and that's why I mentioned the consensus for FactSet. I mean, that's a good number, and it's FactSet number. It's all the analysts. It's not one particular firm with their particular point of view. And that's why I think it's perhaps more valid. And we'll see, right? We're going to get the 75 basis points. We'll see where we go from there. We're watching the dollar carefully. It's interesting to us that the dollar is kind of seems, I mean, it's tough to say because every time you say it seems to be topping out, it hops up another couple of levels. But with rates having backed up so aggressively over the last month, and the dollar not really making any headway, still at 109 today, 109.60 or something. That suggests maybe we're topping out. We have the interest rate differential shrinking, as we talked about earlier. But those are the things we're watching. And then one other point I'd like to bring up as well is going back to some of those early bottomers, right? Our thesis being that, China tech, ARC, innovation space, the thematics, really when it led us into the bear market in January, February of 2021, and are leading us out of the bear market by bottoming back in the spring, April, May. KWEB, the China tech ETF, bottomed in April. ARC bottomed back in early June. ARC is outperforming just even over the last month and over the last 3 months. I checked the data today, outperforming NASDAQ over that period. So, you could argue that the things that are let us in are also leading us out. And again, suggesting that we're trying to put in a durable bottom and moving, from there. But I do think it's worth noting that the innovation space, ARC is still up a good 20% or more from its low several months ago. And that's not the kind of behavior you'd expect if people were still really uber bearish that in innovation space. And so that's another thing that to us, it's much more, from our point of view at TPW Advisory, things are much more finely balanced than the market is positioned, right?
Yeah.
Much more finely balanced than record low risk appetite, record high cash, record low equity allocation. I don't see us in that environment. And I mean, it's frustrating because the market chops around and certainly, hasn't been a great year performance wise for us and for many, but it just doesn't feel, I think there are things that you can talk about that are positives that are not seemingly getting much credit, at least for the moment.
No, I agree. And going back, and your point on the early bottomers is like the first in, first out, right?
Yeah.
The first ones into the bear market, the first ones out, and it seems that there was I mean, I didn't look at the volumes, but it seems that there was an awful lot of volume and an awful lot of selling at the lows of June. So I mean, of course, God knows, where the market is going to go, but it looks like, there was so much selling that there's not enough, there's not a lot of people to sell anymore. I mean,
Well, yeah, and
not
you
a lot of people
notice
left to
that.
sell.
Yeah, and you noticed that last Tuesday
Yeah,
when you were down 4%, but there was very little volume. There was
yeah,
just no buyers, right? Everybody just stepped aside, and the programs, the algos were trading and just trading against themselves, and took us, right again to the level, a technical level. And I think that's really where we're at, because there's not enough conviction for people to say, oh, we want to reallocate in. And so there needs to be some of those catalysts, and those catalysts can be the end of the front loading, the rolling over of the dollar, another quarter of decent earnings growth, making it again hard to argue that the time to argue that we're going into a deep recession that is going to lead to significant earnings declines, which is going to take the S&P down to 3,000 or 2,500, is running out. Because if we're going to be at 4% inflation by March, then we're not going to be extrapolating, ever higher hikes and more aggressive Fed that's going to, quote unquote, force the economy into the abyss. If inflation's at under 4% by March, that argument's going to be done.
yeah.
And so that's only 6 months away. And the market should be starting to think about that, 12 months, the next 6 to 12 months, that should be starting to enter kind of the mentality of the market. It's a forward looking, supposedly a forward looking discounting mechanism. So to me, it's like stale bearishness. It's not respecting the improvement in the trend in European energy prices, not be willing to extrapolate the last several months of inflation data in the US and thinking about what it means for inflation 6 months down the road, and not really recognizing again the environment we're in. We're no longer in the low growth, low inflation, post great financial crisis environment. We're in a different environment that is a high nominal growth environment that is going to lead to good sales numbers and decent earnings numbers. And so that time frame to be as bearish as record low allocations to equities and record high allocations to cash, that can't be sustained for too much longer, I don't think. And that's where I think things are at right now. We'll see what happens on Wednesday. I don't think it's going to be that big a deal. 75 basis points. It's not going to be 50. I highly doubt it will be 100. I think it's going to be 75. Then maybe start to signal, we're going to start paying attention as to where we're going and the impact. It's going to be interesting to watch, as I said earlier, the updated economic forecasts, right? The ECB, when they released their updated forecast, it didn't get much attention, but they're not calling for recession.
Yeah.
ECB is calling for 3% growth this year and about 1% growth next year. That's much better than most of the banks have. Now, we'll see who's right, but I think it's going to be worth paying attention to what the Fed expects in terms of the economic data or economic forecast, because that will maybe tell us a little bit about how they expect this aggressive front loading to actually feed through the economy, over that forecast period.
Would you agree that, you know, I mean, of course, the market was up today. God knows what's going to happen tomorrow, but that the odds are more of a relief rally with the Fed than the other way around. Uh, bec- simply because everybody's just too bearish. So I mean, I think where do you think the asymmetry is today?
Yeah, I mean, I guess that would be kind of more my bias, but I think we're going to want to wait and see what happens with earnings. I don't think the Fed number. I don't think Wednesday is going to be that big a day, one way or the other. I think we've gone down to 38.50 on the S&P. We're chopping around. The next move is probably going to be earnings related, right? Because again, the Fed is pretty much clear cut. The market is pricing 50 and 50 in November and December, pricing at a Fed funds terminal rate of around 4.5 at the middle of next year. And all that seems pretty reasonable to me, especially given the view of, if we stick with the current inflation trends of month over month, flat to down or up slightly, we're going to get to 4% inflation before March.
Yeah.
That I think is a really important exercise for people to think about, because it helps you back into the time frame that we're dealing with, right? We're in middle of September, late September. So October, November, December, January, February, March, 6.5 months from now. That's not a lot of time to jam in a recession that's going to be so bad that it's going to lead to a sharply lower earnings profile, which is going to lead to a sharply lower S&P. I kind of think we're running out of time for that environment to manifest. And if that's correct, then it no longer makes sense to have record high cash. It no longer makes sense to have record low equity allocations. It no longer makes sense to have the lowest risk appetite in the history of the survey, 20 years or so. And that's my point. So that's where the bulk of the money is on the sidelines. So yes, the opportunity is for that money to start moving back into the market when it recognizes that we've run out of time, so to speak, for the bears to have their recession and their deep, earnings shortfall. That's where I think, it's kind of like a denouement, right? It's not a cataclysmic outcome. It's not a sharp and violent outcome. It's just kind of like we ran out of time. We no longer have time for a big recession, because the Fed is not going to do much more, because we're at 4% inflation, February, March of next year. We're already done. So then you have a Fed funds rate that's well above inflation. You have real rates that are already reasonably high. You have a pretty tight financial conditions environment. And all that maybe starts to ease as we get comfortable with the idea that inflation is going to start or continue to gradually decline. And, we keep waiting for that period, for that number to show up. And I'm not sure, it may not be a big step down number that allows everybody to say, okay, done, and we pile in and we go up 10% in a month or something like that. It may not work that way. It may just be people starting to dribble little cash back in, because they're starting to think about these trends, the gas trend in Europe, the property market trend in China, the inflation trend in the US, and realize that things are turning, and it's time to start, turning with that and taking some of that record cash and putting it to work in markets that are cheaper than they've been in 20, 25 years.
Yeah, I agree. And another thing I would add, let me know if you agree, is inflation expectations, right?
Yeah.
And they seem, pretty well anchored. So, of course, we all know there is an issue now because of, COVID, the war, and all of these things, and the supply chains. But the fact is that the Fed has been very effective in controlling expectations, according and contradicting these people that say that the Fed has lost control of expectations and all of that stuff.
Yeah, obviously it's completely wrong.
Yeah.
The inflation expectations are very well anchored. That whole thing was a much ado about nothing. They actually changed the data point like 2 days later after Powell spoke.
Yeah.
So no, that's one of the reasons why we think, and we've written about this and talked about it a fair bit, that we think the Fed is probably going to declare victory with inflation around 3%. That they're not going to, hammer the economy into deep recession to get inflation from 3 to 2. That we're in an environment where, with fiscal tightening, right? We talked about that. That's one key. Well-anchored inflation expectations, your point, is another really key point. And the secular disinflationary drivers that continue to exist, a third point, all of which will allow the Fed to feel comfortable declaring victory at 3%. And this is the new environment that I think we're moving into. It's still a fringe point of view, right? It's not a mainstream point of view yet, but more and more people are coming to this point of view. And I mentioned in my writing Oliver Blanchard, who's the former chief economist of the World Bank. He wrote a piece in Project Syndicate making the argument for exactly this: 3% inflation declare victory. Jason Furman, who was Obama's head of his economic council, just made the same argument in the last week or two in another, I believe, Project Syndicate piece, saying 3% is probably where the Fed is going to get to. So that argument is starting to, manifest and gain adherence. And as it does, then you can start to talk about, the CapEx boom that we've been discussing for some time. You can talk about productivity enhancement that we've been discussing. And that's the setup for a much better economic,
the second part of the decade,
a much better economic and financial market environment for 2023 through 2025. And that may be what the innovation stuff is starting to sniff out, and why it's not going down further is because, again, time is passing and we're moving closer to that environment, not further away from it. What we're moving away from is European gas at 350. What we're moving away from is, 0.4% month over month inflation, 0.5% month over month inflation. That's what we're moving away from. And as we move away from this idea, I think we should start asking the bears to say, okay, when are we going to have the recession? When is this deep recession that's going to cause 20% earnings decline, which is going to take the S&P down from 3,900 to 3,000? When? And if they say anything after June of 2023, they probably, shouldn't be really listened to.
Yeah.
Because that's, that time is shrinking, and the Fed is not going to be tightening aggressively in February and March and April if inflation's under 4%. So I think it's really like, and maybe I'm going to start doing this myself, when you talk to people who are bearish, press them a little bit. Say, look, you've been saying this for a long, long time. And, when is this going to actually happen? Because if they can't say when it's going to kind of happen with some sense of comfort, then you have to start to discount it. And
it's like you say, it's lazy thinking, right?
Yeah, and my point would be that everybody is in the record high cash, record low equity, record of risk aversion. That's where the market is. And so that is arguably in the price, right? This bearish attitude is in the price. But if we're not going to get that recession in the earnings shortfall, then I don't really see how we're going to get to S&P 3,000. And then
exactly.
And when is this going to happen?
Exactly. And would you conclude by saying what we have you have said a few times, and it's been right, that things don't need to get a lot better; they just need to be less bad. Every single one I see on the sell side and on the buy side, they are bearish. I haven't seen on the institutional side. So either bulge bracket firms or big hedge funds, all of them are bearish. So where's the marginal flow coming from? Where's additional bearishness coming from?
Yeah, particularly when, as the Bank of America survey shows, we're at record high cash. I guess we could get another record high cash for sure, but we're already at record cash, already at record low equity allocation, already at record high risk aversion. And that's the point. That's where we are, right? And where are we going to go from there? Unless you can make the case that within a couple of months, you're going to really have that sell-off. Do you really think, one good question for the B of A people would be, okay, how long do these periods typically last, right? When you have these, positions that are extreme, record high cash or record low cash, whatever, how long do they last? Is it a quarter? Is it 2 quarters? Is it a year? Right? So that you can kind of get a sense of how quickly that stuff moves. I just am really, over the last couple of days in this conversation and preparing for this conversation, really starting to think about stale bearishness and a shrinking time frame for the bearish recession argument to actually happen. And so that's where I think we can start to, maybe push back a little bit. Right now, we'll get through the CPI. It's going to be 75 basis points. Don't think it's going to make a huge deal. Pay attention to the economic forecast. That will give us a sense of how the Fed thinks these rate hikes are going to move through the economy, right? And then we start focusing on earnings. And remember that the bar right now is a 4% year-over-year earnings growth for the S&P. I don't think that's particularly aggressive in an environment where nominal growth in the U.S. is growing at 6 or 8%. That's the point that people keep missing. Nominal growth is growing at 6 or 8%. Earnings growth of 4% is not a big hurdle in that environment. So I think we're going to meet that number, probably do a little bit better. And again, that's not going to take the markets down dramatically. And that's where I think the onus, at some point, the onus is going to have to shift to the bears to prove their point. For a long time, they've had the running, and bulls have been coward. Now I think it's going to start to become time for them to really, manifest their case or start to move off it. And once, you start moving off it, you've got all that record cash that's got to come back and find a home. And you're going to be finding a home with the euro and the yen at record low valuations, 40% undervalued, according to OECD. Europe, 11 and a half times earnings, China at 10 times earnings, EM at 10 times earnings. I mean, some point we're going to switch and it's going to be bargains galore, right? And it's going to be like, let's off to the races. So at this point, I think the bears need to start saying, when exactly is this recession going to manifest? And if not, you need to start moving off it.
All right. So, it's been great. We're ready, 5 minutes after the mark. Great. So let's stay the course, and I'll close, with your quote. Things don't need to be a lot better; they just need to be less bad. And there's already too much bearishness priced in. So let's see how Wednesday goes.
Excellent.
So thanks a lot, Jay, and speak to you in a couple weeks.
Excellent, Roberto. Great being with you as always. Take care.
Likewise.